Welcome to The Explainer. Today, we're unpacking a truly historic Q2 2026 earnings report from Analog Devices, or as you probably know them, ADI. Look, if you follow the semiconductor space, you already know not all chip companies are built the same, right? And ADI's latest numbers? Man, they're a masterclass in highly profitable, mission-critical engineering. So, let's dive right into this and see exactly what makes this quarter so exceptional. $3.62 billion. That's ADI's total revenue for the second quarter of 2026. I mean, they completely blew past market expectations with this one. It's a massive 37% jump year over year, signaling some serious momentum in their core markets. But hey, revenue is only half the story here. To understand how they did it, we're going to cover the record-breaking quarter, revenue by the numbers, margins and market power, cash flow and returns, and wrap it up with the future outlook. All right, Section 1, the record-breaking quarter.
So behind the ADI name is a company that didn't just casually grow its top-line revenue. According to CEO Vincent Roche, this quarter was the result of a crazy combination of record demand and just incredibly sharp operational discipline. They're investing heavily to keep their technology edge, and you know what? That discipline is showing up directly on the bottom line.
Now, this is exactly what gets analysts out of their seats. GAAP diluted earnings per share literally rocketed from $1.14 just a year ago in Q2 2025 all the way up to $2.40 this quarter. That is a 111% increase. It absolutely proves their revenue growth isn't just empty calories. It's highly, highly profitable. And guess what? This stellar execution definitely did not go unnoticed. S&P Global Ratings actually stepped in and upgraded ADI's credit rating from A- to a solid A. They specifically pointed to ADI's highly resilient end market mix and product leadership. Basically, S&P loves that ADI has these super long product life cycles, giving them way less exposure to the crazy volatility we see in the mobile and PC markets. Moving on to Section 2, revenue by the numbers. When we take a closer look at ADI's revenue mix, it really paints a picture. You can see this massive reliance on the industrial market, which now makes up fully half of their overall sales. Automotive comes in second at 24%, then communications at 15%, and consumer trailing at 11%. And look, this mix, it's entirely by design. They are intentionally hunting in areas where their analog chips are completely indispensable. But the explosive growth within these specific segments is where the real story is hiding. Check this out. While the already massive industrial segment grew a very impressive 56% to hit almost $1.8 billion, communications literally skyrocketed. We're talking a breathtaking 79% jump, mostly driven by this insatiable demand for optical and power solutions to support global AI data center infrastructure. Let's zoom in on that industrial segment for a second, because it's definitely not a one-trick pony. It is firing on all cylinders. This growth is being driven by critical, real-world needs in aerospace and defense, energy, and factory automation. Actually, if you look at their industrial business outside of just test equipment and aerospace, it still grew by more than 40% in the first half of the year. Unbelievable. Which brings us to Section 3, margins and market power. Okay, if you remember one number from this explainer, make it this one, 73%. That is their adjusted gross margin. Just think about that for a second. For every single dollar of product they sell, 73 cents is gross profit. That is off the charts for the semiconductor peer group, and it's actually up from 69.4% just a year ago. Oh, and their adjusted operating margin, that hit a phenomenal 49% too. So how on earth do they pull this off? Well, CEO Vincent Roche kind of hits the nail on the head right here. They can command these premium prices because they're solving the most complex, headache-inducing, mission-critical problems for their clients. They aren't out there selling commodity chips where the cheapest price wins. No, they're selling highly engineered solutions that their customers quite literally depend on to survive. This really highlights their competitive moat. Unlike companies that are chained to the short life cycles of consumer cell phones or laptops, ADI enjoys these incredibly long product life cycles. Their chips are going into industrial machines and automotive systems that are built to last for decades. What does that mean? Low inventory obsolescence risk, and extremely high switching costs for their customers. Once you're in, you're in. And a huge driver of these juicy margins, and a term you're going to hear a lot when talking about ADI, is ATE, or automated test equipment. Basically, this is the essential testing gear that electronics manufacturers use just to make sure their own stuff actually works.
Manufacturers absolutely rely on this equipment and will happily pay a premium for it. ADI management even noted this business is on a steep growth trajectory with clear visibility well into 2027. All right, moving on to Section 4, Cash Flow and Returns.
Backed by this fortress of a balance sheet, ADI has committed to what is arguably one of the most shareholder-friendly policies out there. They have a stated goal of returning 100% of their free cash flow to shareholders over the long term, meaning if they make $1 of free cash, they want to put that dollar right back into investors' hands.
And wow, do they have a lot of cash to give. Thanks to a really clever hybrid manufacturing strategy that keeps their capital expenditure targets super low, we're talking just 4 to 6% of revenue. They generated a staggering $5.1 billion in operating cash flow, and from that, $4.56 billion in free cash flow over the last 12 months. That free cash flow, it represents 36% of their total revenue. So they're taking that massive war chest and putting it directly into investors' pockets. In Q2 alone, they handed back $1.3 billion. But here's the real kicker. They recently authorized a massive $10 billion addition to their share repurchase program. That brings the total authorization to roughly $11.5 billion. And if that wasn't enough, they raised their quarterly dividend by 8% to $1.10 per share. That marks their 21st consecutive year of higher dividends. Just incredible consistency.
Let's wrap things up with Section 5, the future outlook. Unsurprisingly, the outlook for Q3 is incredibly bullish. The company is actually projecting revenue to step up even further, targeting $3.9 billion. They're expecting adjusted earnings per share to hit $3.30, and they anticipate maintaining that wild adjusted operating margin of roughly 49%. Clearly, the demand signals are staying highly positive across their business-to-business markets.
Now, of course, they aren't the only players on the board. They face some genuinely fierce competition from heavyweights like Texas Instruments in the industrial sector and Broadcom in communications. But ADI's unique focus on optical and power solutions has perfectly positioned them for this unprecedented AI infrastructure build-out we're seeing right now. As 5G and AI data centers keep expanding, there's plenty of room for ADI to snatch up premium market share, even against those formidable rivals. It's just an incredible financial setup across the board. You've got sky-high margins, long product life cycles, and surging demand in mission-critical industries. Which leaves us with one final thought to ponder. As global AI data centers continue to demand more optical and power efficiency, and industrial automation just keeps accelerating, how far can Analog Devices realistically ride this wave into 2027 and beyond? Thanks so much for joining me on this explainer, and I'll catch you next time.